before we get started. We've muted everyone and we're going to keep everyone muted. We will be taking all your questions at the end via the chat box. Any specific questions, we're happy to talk offline, but we'll be taking all the general questions at the end. The slides will be available after the webinar, and we will be recording today's webinar. At Dillon & Stang, we made the choice day one to dive into the CARES Act and begin digesting what is the largest stimulus relief package ever. It has now been nearly 6 weeks that our incredible business advisory team has spent every waking minute reading, understanding, and presenting on the Act, not to mention continuing to help our clients navigate these uncharted waters. Even as we present today, there continues to be updated guidance issued on a daily basis. For the latest updates, we suggest you follow us on social media and check our website. We will continue to work passionately to help in the best way we can, guiding businesses to survive and thrive through this pandemic. Our main speaker today is going to be Brad Hoffman. Brad is co-managing partner of Dillon & Stang CPAs and Business Advisors. Dillon & Stang, for those of you that don't know, is a professional service firm focused on helping you succeed through strategic business insights and practical advice that keeps you moving. And on that note, I will let Brad take it from here.
Excellent. Thank you, Brett. Welcome back, everybody, or welcome back for those of you who have been on one before. Some things will seem like a reiteration of one of the previous webinars, but we build up and we're going to go through a little bit of a workbook at the end. But before I get there, I just wanted to touch base on, kind of myself, for those of you who aren't familiar with myself or the firm. Obviously, Dillon & Stang has been around 35 years plus, as Brett mentioned. Myself, I've spent over 20 years in the business arena, and whether being a business or helping businesses, it's kind of the passion of my profession. As Brett mentioned, day one, we put together a CARES team, and it got coined that pretty quickly. Most all the questions in the firm run through somebody on this team. That's many of those are on the call today. These guys and gals are awesome. They've put in countless hours staying up with this and staying on top of what we're dealing with here, and helped hundreds of businesses at this point with the CARES Act or some component thereof. On the call, just to kind of highlight some of the main players, our head of research, Naji Lakis, he's been instrumental in pulling together a lot of the research for this. Stephen Kerensky, who heads up our business service team. Danny Rosamondo is also a major part of our business service team. And I believe he's on here as well today, is Clint Lehman, who heads up our nonprofit test side of the team, and has assisted many nonprofits with this. That we'll get started on what we're dealing with here. To get started on kind of what we're dealing with, as Brett mentioned, the SBA and the Treasury has yet to release definitive guidance on how some of these calculations are actually going to unfold. Everything we've done is based on the CARES Act and the most recent interpretations that we have of the CARES Act, to include the question and answers that the SBA has released on an ongoing basis to help guide everyone through the interpretations. The presentation assumes that the loan in question qualifies for the program. There's been a lot of conversation and media put around question 31 and then question 37 relating to taking a close look at your certification of need or desire, or ability to obtain the loan. What I can say is just as early as this morning, the AICPA Barry from the AICPA, the CEO, released a blog post which was very positive and pro-business, if you will, related to, your interpretation of receiving these funds and utilizing these funds in the best interest of your business. And won't quote it, but I would recommend, and I can send out the link later to take a read of the blog post. It was very insightful and relieving to see the AICPA, who is a major player in guiding the SBA and the Treasury on putting together these ultimate guidelines down the road and giving recommendations. So it was very relieving. But all that said, this presentation is put together with the interpretations that we see and some assumptions, and we'll touch base on the assumptions as we go through here and move forward. So an overview, we're going to touch base on understanding the loan forgiveness, how we believe it's calculated, ordering rules, what gets limited first, what costs go in, so on and so forth. What you need in order to prepare for the loan forgiveness, documentation to a certain degree. Then, what to learn from our thriving organizations. We as I mentioned, we've been in touch with several hundred businesses at this point throughout this, and some have pivoted and are definitely making the best of the situation. Just kind of touch base on some of those, and then some items on what to prepare for the new normal. Roads, the road recovery, your comeback plan, so on. So let's get started. I think the reason why everybody's here is the understanding what may be forgiven. So much of the media said, you use the costs correctly and you use it for the intended purposes, and it could be 100% forgiven. That's true. We want to touch base on what that looks like. Then there's partially forgiven. How does this work, right? I mean, there's many components of the payroll protection program, and understanding how each of them play with each other will be very important as you work together to figure out what you're going to do with your payroll protection program proceeds. So potential full forgiveness. Next slide. And as I mentioned, it can be fully forgiven if your calculation, calculation was based on 2019's payroll. And if you kept all your employees and didn't change their payroll and all your costs remained the same, throughout 2019, and it's still the same as of right now, likelihood is high that you're going to be in an eligible state of full forgiveness. However, there are many surprises that we're finding as clients are bringing their ultimate loan documents and then their new payroll numbers to us as they're rolling right now. And one example, this is why I say don't be surprised, run the numbers. Even if your current ratios where you didn't let someone go after the first quarter, and your first quarter payroll and your 8-week payroll is exactly the same and the numbers are exactly the same, we've seen instances where just due to timing, you had a higher payroll number throughout 2019 because you hired more people late in 19, seasonal to some capacity. And so your loan was calculated on a much higher number than your actual qualifying costs are right now and likely would be moving forward. So we'll touch base on that and I'll show you in the workbook, but it's just important to know that even if you have kept everything the same, it would be worthwhile to take a look so that you're not surprised at the end. So with that, moving partial forgiveness, and what elements and what costs and what things can impact your partial forgiveness or the amount of full forgiveness, decreasing full forgiveness. First would be your actual eligible costs. And we'll go through that. Second is the no more than 25% non-payroll costs. They put that limitation in very late in the game, but it's in there. Then there's the well-known 25% reduction for employees. So no more than 25% of the employees' comp can be reduced. reduction in the number of full-time equivalents. We'll touch base on what an FTE is. And then received a grant covered under Section 7A. That's more of a specific question. We threw it in here so it was acknowledged and known about, but if you have a question on that or you received a separate grant or loan and have a question, feel free to reach out to us on that. Okay. Some important dates, and these are extremely relevant as we get into the calculation. The loan origination date, that starts your 8-week period, and we'll touch base on that in a little bit. February 15th through June 30th of 2019, that's one qualifying period for your FTE calculation. Your other optional qualifying period is January 1st, 2020 through February 29th, 2020. You can use either one of those in calculating your FTE ratio. And then June 30th, kind of one singular in the CARES Act is one statement that says if you restore all your FTEs and you restore all your payroll, the full thing's forgiven at the end, and it's general in that nature. I didn't quote it exactly there, but we haven't focused on that a lot because so much of the CARES Act was built around what limits it. We're skeptical on what they're ultimately going to come out with as meeting that criteria to have full equivalent just based on the June 30th date. So again, much more clarity needs to be put around that. We're not going to focus on that. Just want you to know that exists. All right, preparing for the covered period. Your covered period, and there's some hope and some work being done on this, but currently your covered period is the date you receive the funds continuing out through an 8-week period. So from the date you got your money through 8 weeks is your covered period that your qualified costs are calculated and accumulated. The AICPA, MS, and MACPA, and several other state societies are pushing the AICPA and Treasury and the SBA to make that 8-week period a little more flexible. They understand that many businesses are not up and running at all and could really use to have these funds become available once they can open the business and use those for qualified payroll at that point. AICPA and the state societies are pushing for either flexibility with your 8-week period or to be able to perhaps start your 8-week period after your governor lifts the stay-at-home order or when your business is allowed to open. None of that is law or any way reliable at this point, but we just wanted you to know that the people that are pushing and lobbying, if you will, for your benefit are pushing for that to be flexible so that you have some more room to play with these dates and how to get these costs in there in order to get forgiveness. There we go. And I'll stop for a second. I'm going through the slides pretty quickly because we've put a workbook in here and an example that we're going to go through closer to the end that'll help kind of visualize everything that's happening here. Obviously, these are calculations, and if you're like me, I need to kind of see it on screen and see how it unfolds in order to understand it. But back to the slide. What are your eligible costs for forgiveness? And this differs from what you use to calculate your loan because there's some other things included. The first is your payroll cost during that 8-week period. We'll touch base on that. Now what's added to this are interest obligations, rent, utilities, and utilities has a laundry list of things that are inside of there. So there's additional costs that get to go into the qualified cost that calculate and accumulate for the forgiveness number. We'll touch base on those next. Okay. First, gross payroll. So these components are virtually the same as when you prepared for your loan. You have gross payroll, and then you have all the components of gross payroll. And this list below is just the list of things that would normally be inside of gross payroll. Then you have your additional payroll costs of employer-provided healthcare and employer-provided retirement costs. So if you paid $1,000 in a month in healthcare cost, and the employee withholding portion was $300, you can add that $700 into the qualified cost, and that actually goes into qualified payroll costs. The other thing to note here, employer paid payroll costs, we've received some guidance from a couple banks, and there isn't guidance in the CARES Act, so we'll be looking forward to guidance from the SBA, that if you accrued your 2019 retirement match for the employer side, and let's say you would normally pay that in the summer or up through September, and so this is a window for which you would normally pay your employer matched retirement for 2019, that's a cash outlay that we believe would qualify or go into those payroll costs in this calculation. Again, still waiting for guidance on that, but as of right now, we believe that that's a qualified cost that could go in there. And that could be very big for helping to get you to where your costs need to be for the forgiveness component. Okay. The elements that we can include in payroll, again, this is very similar to what it was when we calculated the loan. We have to remove any wages associated any wages in excess of $100,000 per employee. So if the employee made $125,000, we would only include $100,000 of the costs associated with that employee. And obviously it's an 8-week period. The best interpretation we have right now is that you're using your annualized $100,000 number divided by that 8-week period and accounting for that with those costs. Quick thing to note, the qualified sick leave wages and qualified family leave wages that were part of one of the previous acts associated with COVID-19, if you received credits utilizing those wages, we would exclude those wages from this calculation. And again, we're going to hit a lot of this on the example as we go through the example. The non-payroll cost, this is the additional costs that we get to add in now. This is your mortgage interest. Interest on equipment loans, interest on business debt that you've accumulated, but it had to have been in place prior to February 15th. And a special note, this does not include Schedule C's and interest associated with their home office. Utility payments, electric, gas, water, transportation, telephone, internet. Interesting one here is transportation. We say be careful on this one because it seems pretty open-ended that one sits there as utilities, and we're not exactly sure what they mean, and they have not guided us on this yet. But we believe it could be utilities on the trucks, cars, things that are necessary for transportation needs inside of the business. But I would be real cautious on that one because I think that one could get gray on us quickly. Okay. First reduction. So we've accumulated all of our costs. Now we start to go through all the limits or the limiters. So first we had our $100,000 per person limit. Now we have the 25% reduction per employee. To try to simplify this one real quick and get to the workbook, if you paid somebody $100,000 salary, so their salary is based on $100,000, and that you paid them that amount in the first quarter, but then the outbreak hit and you said, okay, I'm going to drop you down to 70 and base your compensation on 70. Well, that additional 5%, because you didn't keep them up to 75%, would actually come back as almost a penalty, but it's basically a reduction in your allowable costs. So you would have a $5,000 additional reduction because you reduced that employee by more than 75%. Now, there actually has been some guidance released, and this is good news, employer friendly, business friendly. One of our troubles before was that employers were having a little trouble getting some people back if they were opening, because unemployment was paying them more money than they would be able to make if they came back to work. Well, SBA released question number 40, which in very simple form said, if you offer an employee their job back at same wage and same rate and same hours, and they refuse, and you did that in good faith, and you have a written document of that, so you have a written document offering them the offer, and they have a written refusal, they don't count against you in your limitation calculations. Either your FTE, and as best we can tell, you're also your 25% reduction. There's a caveat there, and it's important you know this. If they refuse, they are then ineligible for unemployment. So just be aware of that as you're communicating with your employees and putting a strategy together to try to increase your forgiveness costs. So move on. The next limitation, this is the one that came in kind of late in the game. No more than 25% of your qualified costs can be non-payroll. So if your interest, your mortgage, or your interest in your rent and those costs come up to $30,000, but you only have $75,000 in qualified payroll costs, well, you're only going to get $25,000 of non-payroll costs to add to that $75,000, capping you at 100. The extra 5 just sits there. It doesn't get to qualify as qualified costs. Then you have your FTE calculation, probably one of the more confusing ones in the entire PPP program. This is where those 2 date ranges that I told you come into play. So you have your date range for February 15th through 19th, June 30th, 2019, or January 1st, 2020 to February 29th, 2020, compared to your average FTE for the 8-week period, creates a ratio. That ratio is ultimately applied to the total bucket of costs after those other limitations that we previously talked about. And we'll touch base on that as we get into the example. I think it's a little bit clearer. All right, so with that being said, let's jump into the workbook example. I'm gonna share.
All right, so Brad, as you bring that up, just a reminder, we do see all your questions coming in. We appreciate those. We will get to all of them at the end, so don't think we are ignoring you. We will get to those very, very shortly after the slides finish up.
Awesome, thank you, Brett. So I'll try to keep this in a similar order to what we just went over everything, and walk down through it. And again, I do realize it's fast, and there's a lot to absorb here. This is an example that we put together to help illustrate how many of the components in the CARES Act or in the Payroll Protection Program work. The workbook itself we have is in the form of a workbook, but we put this together with some examples. So we're going to go down through it in order. Okay, your payroll costs, we broke our payroll costs into 2 components. Payroll costs paid with payroll, and then payroll costs that are not paid with payroll. So, and then we have our non-payroll costs, which are your other costs. Actually going to start backwards and go the opposite direction and start with our non-payroll costs. So our expenses not paid with payroll, and they're actually not payroll costs. These are your utilities, your interest, your rent, all the things listed in the other costs category of the program. As you can see, this example here, we have $10,000 per month. We have some power, water, utilities, etc. Summing up down here at the bottom, we have $8,000 of utilities, $7,000 of interest, $20,000 of rent. Okay, so there are non-payroll costs. Now we have our now we have our payroll costs that actually aren't ran through payroll. So your health insurance and your retirement. Reason we broke it out like this is just because they're the ones that most employers are going to cut a check for, as opposed to having it be pulled out of their payroll account or having their payroll provider pull the money out. So giving you a way to track and account for that throughout your 8-week period. The important part to note here is these all come up to the front, and we'll touch base on those in a moment. Next is our payroll cost. So this one gets, there's a lot going on here. So first we have our $100,000 limitation, and this was the same limitation that we had when we did the loan. We created this example right here. Make this a little bigger so I can see it. Okay. This is an employee that we're saying that was at $100,000, was at $100,000 before and during. And as you can see, as you walk across, these were the wages that we would have paid them during our first quarter, the $25,000. Then our per payroll costs for that $100,000 employee, they match out. Our max wage is $16,666, and our wages paid were $16,666. No reduction here. Also notice no reduction out here because our payroll stayed the same. Now we have an employee at $125,000. Okay, here's our wages that we paid them during the first quarter. As you can see here, we still paid them based on the $125,000, but this example, it still limits them down to the $16,666, having an excess wage reduction of $4,166. And that will flow through on the front here. This makes up our gross wages that we paid, our real payroll. And there's our $4,166 for the reduction in excess wage. So we come back to our workbook. Our next reduction is the $25,000, or excuse me, the no more than 25% reduction in payroll. This person right here was at $70,000. In Q1, we reduced them to $52,500. Here's their first quarter wages. Here's the reduced wages, or their wages based on the reduced payroll. $52,500 happens to be exactly 75%. As you can see, there's no reduction in their, or there's no reduction to our forgiveness for reducing their comp because we stopped at 75%. Inversely, this person up here had $100,000 prior to April 1st. In other words, first quarter wages were based on 100. We reduced them to $70,000 for the second quarter and forward. So during the 8-week period, 25 is their first quarter payroll, very similar to the other $100,000 employee, but they were reduced down to 70. Now, as you can see, I had a reduction out here on them of $833. That's because I reduced them by more than 25%. So the difference between what I reduced them to and the 25% is what I have to then reduce my forgiveness cost bucket by. Now, this number here, this 2883, that's my total 25% reduction. That flows out here to, again, reduce my gross wages to get down to my qualified wages number. Adding back in now my health insurance that I paid during that period, employer paid health, and then my retirement payments that I've made. That gets me to a total qualified payroll cost number of $97,733. The importance here, and the most important part for everybody to understand, is that payroll is the driver on the forgiveness calculation. Most everything associated with the ratios and calculation depend on a component of payroll. So I'm a total qualified payroll cost. Remember earlier we went through the non-qualified or non-payroll costs, 20,000 in rent, 8 utilities, 7 interest, got me to 35. Well, now we need to talk about that second 25% limitation that we mentioned. No more than 25% of our qualified costs can be non-payroll. Well, we had too many. We had 35 grand. We were only allowed 32. We've built this thing so that it kind of automatically does it, and it shows our ratios. In this particular case, if you look out here in H35, prior to our limit, we were actually at 73.63% payroll costs. This limitation here of the 2,400 brings us back in ratio to 75%. So that drops my qualified other payroll costs down to 32 grand, 32,577. So now we add our payroll costs, A, with our non-payroll costs, B, to get to the $130,000 mark of total costs eligible for ultimately our final limitation. Actually, that's not true. Second to final limitation on the forgiveness. So we have 130,000 in qualified cost. Now we have to look at the FTE calculation. And this is probably the most popular reduction or calculation that's been talked about in the news, so on and so forth, with bring all your people back, bring your numbers back. Well, FTE, they use the term FTE, full-time equivalent, in the CARES Act. Ironically, they didn't define full-time equivalent in the CARES Act as it related to the Payroll Protection Program. They did mention it in the employer retention credit section, and they referred to a separate reg that used 30 hours per week as a full-time equivalent. Most everybody that we've seen has also went along those lines, and we've built our ratios and our workbook in accordance with that. So remember, we talked about the 2 optional periods that you had to qualify your full-time equivalents. So in this particular case, we said that they didn't change anybody from in 19 through end the first quarter of 2020. So in here, we give everybody a 30-hour number, which basically gives them a 1 for equaling a full-time equivalent. In our January 1st through February 29th period, same thing. We gave them all 1s, we gave them all 30s because they were there full-time throughout that period. Now we get to our 8-week period. And as you can see, this person down here, and I'll go back to this in the payroll side also, he went part-time, and his compensation was reduced back to half. He was at 50,000 and now he's at 25, and he's only working 20 hours a week. So we give him a 20. Now, the way the full-time equivalent works, and if we're using 30 as a base, which again, that's in our interpretation and they've not defined that, we're waiting on it. It doesn't give him a 0.5, it actually gives him or her a 0.67 because it's 20 out of 30. Now, the important part to note there, and as we move forward, is how much just those 20 hours managed to impact the calculation. If we look up here, the 20 hours, so over here in E30, these are our 2 qualifying periods. 7 full-time equivalents during the qualified period of 19, and 7 full-time equivalents January 1st through February 29th. The one person that we reduced to part-time, 20 hours, changed my ratio or my FTE count during the 8-week period to 6.67, bringing my FTE test ratio to 95%, basically. That person being reduced to part-time or reducing 20 hours, as we're seeing this unfold and how we've interpreted this, would reduce our eligible cost or our eligible forgiveness by $6,200. bringing us to 124. The reason I said earlier that this is our second to last test is the CARES Act actually does state, and there is reason for it, but it seems strange. Our 124 comes up here as our total potential amount forgiven. The last limitation that they have in the program is that you can't be forgiven for more than what you borrowed, which seems straightforward, but the way they have some of the EIDL loans able to be rolled into this, it makes sense that you're only allowed to be forgiven the amount that was borrowed under the payroll protection program or paycheck protection program. I keep saying that. So as you can see, originally we borrowed 140, and that's based on what our payroll was prior to any reductions or anything like that, based on 2019 and the numbers we had in there. This amount forgiven is based on what we just went through in this workbook. We would end with a loan of $16,727. And that amount then could either, well, again, further guidance is needed, but it could be paid back or turned into the loan that would roll out over the 18 months following the 6th month of the loan. And that's going through our workbook and the calculations. Again, as we see this, there's a lot to be determined yet in ordering. We've put these things in the order that makes most logical sense to us. And again, we've seen others who've followed suit, if you will. There's guidance needed to define that. There's also guidance needed to define part of this here, as we talked about the reduction in wages. We have this built, the way the CARES Act reads as we read it, is it applies per person. And ironically, if a person left, the way this is built, it could actually double count or double reduce you. We believe that they're going to remove that and have the FTE count be the reduction if they're gone in total, and the wage reduction limitation be the reduction if they're still on board and you're still paying them. Again, a lot more details to go along with that, and you know, we can certainly pose questions or answer questions as we get further along. Next slide, I will turn this back to Brett. Stop sharing. All right, so next one. All right. Part of the CARES Act, when it was rolled out, and they talked about this very openly and made it a very positive thing, is that the forgiveness component, it's basically debt forgiveness, but they declared in the CARES Act, or they declared originally, that it was not going to be taxable. Recently, the IRS issued guidance and said that they were going to disallow the deductions associated with costs used to obtain forgiveness. That's kind of a long way around saying we're going to tax it. It comes into on the back end by removing the deductibility of the costs. Now, the AICPA has been very vocal on this, and many members of Congress, both sides, have been vocal that that was not the intent of the CARES Act, and they're actually proposing a bill or a change to that IRS clarification to again remove the taxation of the debt forgiveness in the CARES Act, or on the payroll protection program. And we will update as we get more data. Materials. So, you know, our firm has sent out checklists on putting together your elements of the program. There are tons and tons of people out there who have put together lists to put your numbers in and count for your data as you go through. I can't express enough that regardless of what tool you use, you need to do that, and you need to document all of your activities. And there's many ways to do that. So I don't want to go through it like a prime example. Some people have secondary checking accounts. Some people are transferring money over. Just know that ultimately you need to be able to support the data that you're providing in your package. And I would have it be as systematic and clean and clear as possible, and have all your payroll reports and all your payroll information broken out accordingly. The other element that I will recommend, I touched base on it earlier with question 31 about, should you have received the money? Were you eligible? Did you have alternate funding? Did you feel financial uncertainty as you applied for this loan? The AICPA's guidance at this point and the MACPA's guidance is document, document, document. Not just document your payroll, but document what you were feeling on the day you applied for the loan. What outside factors were you experiencing? What were you hearing from your clients? What were you hearing from your vendors? What were you hearing from your staff? Document your concerns, document your forecasts at that point and points after that, weekly if need be, of, hey, here's what we're experiencing now. We're worried about, people being able to pay us. We have sales, but we're not sure we're going to get paid. Or our vendors are talking about running out of supplies, and that's going to essentially shut us down on the back end. We have one person that went out with the virus, and we're not sure who all they were in touch with, and we might lose half our workforce. Document all of those things and the dates you're feeling them. And that seems weird to say in an accounting webinar, but as of now, the AICPA's thought is that this thing was designed and intended with the intent on the day you borrowed the money, and you should document those on out. Now, obviously, question 31 and 40 had clarification to the original instructions, but document everything and then document it again. I can't recommend it enough. All right, as we move into kind of the softer side of this, what I'll say is, we've been in touch. The entire CARES team has been in touch with, like I said, hundreds of clients and potential clients, and we've experienced some amazing stuff. For what it's worth, being a business consultant, like this is the most amazing time of my professional career, being able to help this many clients and have the ability to just walk them through and make their decision and assist. And there's been many clients and potential clients and just people on webinars who have pivoted, and they've been able to reinvent their business during this period of time to make it viable or at least break even, so that when they come out, they're able to be strong. A lot of those things depend on the leadership at the organization. Those who have good leadership and are communicating with their staff and their customers and their vendors, that means a lot to each of those people. If you think back to when you were getting your PPP loan, one of the biggest things I heard was, man, I don't know where my loan is. No one's communicating with me. I haven't heard from anybody. I don't know where it is. And it's really unnerving. So put yourself in the shoes of your customer or your vendor or your staff, and, just remember that and think, okay, I need to communicate with those people as well, because it's pivotal in this ultimate relationship that I have. Companies that have made changes have been able to pivot quicker. Willingness to make change has enabled them to pivot much quicker. Making a change is one thing. Being willing to do it is another. Objective versus emotional. This is, challenging times, as we continue to hear, there, in these times, you like get your data together, as you see below our essay. Actually, it's on the next slide. It's just strong knowledge of what you have going on inside of your business, having a solid set of books, historical data, knowing that, hey, last year at this time I was here and now I'm here. I need to make some adjustments, or I'm going to be, if I forecast that out, holy cow, this is going to go, down quickly. Or, inversely, like I'm normally really slow during this time of year. Maybe it's not as bad as I think, or maybe it's not as bad as what it appears. These are all hypothetical, obviously, but organized and timely, regardless of how chaotic it is. Get your business together, have your people, everybody on the same page, and make sure that you as a leader, or you as the CFO, or whatever role you're playing, make sure you're getting the data from the right people and on a consistent basis, in a consistent manner, so you're comparing apples and apples. Next slide. The other big component to our strong businesses that we've seen in this period of time have been this team, an advisory team. And I wish I could say this was just self-promotional, but it's not. Having an accountant or a business advisor on your team, being part of your chamber, we're on a chamber webinar right now, having that support team, and then a trade association that you're working with. I mean, we're no different. I mean, I've mentioned the ASCPA and the MACPA many times. Like, that's our sounding board to make sure that we're leading the charge in the right direction. Many of you are trades, and get in contact with your trade association and find out what your peers are experiencing and doing, and maybe there's insight into what's to come, or you can lend insight in what you've already experienced. The financial advisor, being able to that can go along with the accountant, but being able to know that you're either gonna need help or that you're gonna be okay. One of those two, or a plan for the in between. Having that person to bounce that off of, critical. Banker. I think.
Brad,
I need to hurry up. I'm sorry.
Yeah, no, you're good. You're good. I was just we have some questions kind of tallying up here, and I know we're getting.
Okay. Well, let's go ahead and get into that. They get the general gist of this, I'm sure.
Yeah, we're just so everyone knows, we're going to stay on a little bit longer and answer all the questions that we can. Again, we're going to run through the general questions. I do see some very specific questions, and so we will be happy to talk with you about that offline. But if we just go ahead and go up to the top here, I'm going to start from the beginning. As I do that, the first question we have was, what is the importance of the June 30th date?
Okay. As I mentioned earlier, they said, very simply put, it's been said a lot, bring everybody back and have them on payroll and restored by June 30th, and everything gets forgiven. That was a very blanket statement, and we're skeptical that there's going to be plenty more to that. The additional data that they put on that was the payroll was restored and your FTE was restored. Well, if you didn't have anybody working the entire 8 weeks and you brought them back on the 8th week, payroll or wages were restored. We read that could mean that you would need to back pay them for the entire 8 weeks in order to check the box on that. Ultimately, it is the advertised date for that, but we're not hanging our hat on that counting without additional guidance surrounding that.
Okay. There's a number of questions on this topic, so maybe just spending a minute related to independent contractors and sole proprietors with no employees. The first question just asks if it's true that only 75% can be used for payroll, but there's a number of questions after that. So if you just want to spend a minute or two just talking about how this works for 1099 independent contractors and sole proprietors without employees that have received a loan?
Okay. Yeah. And Najee and John, if you want to weigh in on this, if I miss anything, please do. And we can get stuck in the weeds on this a little bit, but when an independent contractor or Schedule C went to apply for the loan, and let's just say they were over $100,000, so we can keep the math simple, or let's say they were at 100,000, so we keep the math simple. They were eligible for a loan of 21,000 and change, or 20,000 and change. They changed the calculation for those people and said, okay, we're going to use the Schedule C that you provided when you filled out the loan application. We're going to use that same Schedule C to calculate your forgiveness. And this is as of now and just based on our interpretation, but we're going to use that same Schedule C, and that's going to be your wages during that period. Now, the same rules apply to the tune of no more than 25% could be non-payroll. So yes, 16,666 would be your forgivable amount based on compensation, and you would need to have other qualified costs in order to get the rest of those dollars forgiven. So if an independent contractor doesn't have rent or utilities or those other costs, it is very probable that they are going to start with a loan of the 20 and change and end with forgiveness of the 16,666 and either pay back the difference or turn it into a loan over the period.
Brad?
Yes.
The forgiveness for self-employed Schedule Cs that I've read as guidance, and until the final guidance comes out, this is just what we have temporarily, is they are doing it based on a 8-week divided by 52 weeks schedule for that. So it comes out to the 15,385.
Oh,
Right.
yes. Yeah, you're right. Thank you. I was using what was
so it's a small difference of about $1,300, but that is the calculation. It's an 8 divided by 52 weeks calculation for that.
Thank you, John. Glad we have that on recording, so I didn't pick that up.
Sorry, were you done with that area, guys, or did you want to have anything else on the 1099 Schedule C employer?
I think that's probably good on that.
Okay. So next question we have is full-time equivalent based on 30 or 40. We touched on that the guidance so far is all alluding to 30 hours per week. And the second part here is my payroll, in this case, my payroll is May 1st to May 15th. I pay my employees for this period on May 22nd, receive my loan on May 8th. How would it work in figuring out forgiveness period? Should I run 2 separate payrolls with the dates that work? So just if you can touch on kind of dates not perfectly aligning with the 8-week period. I saw a couple of questions on that.
It's a great question. Glad somebody asked it. Your confusion's not unwarranted. The AICPA and MACPA are issuing, pushing for, asking or requesting that they clarify this and or adjust this to allow or have the 8-week period fall on a paid date, on a payroll date. So instead of having the funding date be the start of your 8-week period, that you would at a minimum be allowed to move your 8-week period start date to the closest payroll date. As of now, we've taken the interpretation that they're referring to, or that they're going to count it, or they're going to count this using the paycheck date. When you think of how you got your loan calculated, and when you applied, it was based off 941s and your 940 and your payroll data. That data is all generated by your paycheck date. So we believe, and this is an interpretation and an assumption, but we believe that they are going to, as of now, or at least as of now, they're using the paycheck date. So whatever went out with that paycheck would be the wages that qualified.
Okay. Another question here. Can you use the loan funds to pay salaries over 100,000 knowing that won't be forgiven? Or can you not even use the loan funds for that?
Well, that's a great question. And there's actually not guidance on that necessarily. They've stated that the qualified expenses are wages up to 100,000. Now, at the same time, the back end of this, if you think about it, if you don't have enough payroll to get it all forgiven, and or other qualified costs, it converts to a loan. The use of those loan proceeds hasn't been defined either. So we believe you would be able to use it for other costs, but perhaps they meant that that loan turns into a loan and you have to use that loan to then fund payroll moving forward. Say all that to say, it's not narrowly defined at all, or at least the way we've interpreted it, it's not defined.
Okay.
And we've talked about this, the define. The SBA has, in the most recent Q&A, they have came out and said that they extended the date for which to pay back your loan to May 14th. They've also said that they would issue guidance by May 14th. So within the next 2 days, we anticipate there to be guidance out. Honestly, it's also just as likely that they would extend the due date again.
Okay. Does the interest for the existing loans count towards the interest expense calculation?
Yes. So they would need to be existing in place. It's the only interest that qualifies is associated with loans that were in place prior to February 15th, 2020.
Okay. The next question refers to, so they have a home care agency, but let's just say any business where the employee hours change from week to week, hence payroll to payroll. What would be the best way to track their hours and wages in your spreadsheet?
So for clients of ours, depending upon your payroll service, we download the hours reports into our sheets and the wage reports into our workbook, and maintain a running calculation. And in fact, what we do is we load it with the data that you have currently and forecast that out so that you can start to understand what you're going to be dealing with. But I would recommend for anybody that's maintaining this on their own that they run a payroll report and include in that, the wages by employee by week, as well as the hours per employee per week, and maintain that in some spreadsheet or capacity. Ultimately, I recommend that a lot of folks would, if not capable of doing that on their own comfortably, I would recommend them seeking some guidance, unless the SBA comes out with something that is just totally simple on the front end. As you can see, we feel it's a little bit more complex than what it's been played out to be.
Okay. The next question is kind of a statement, and just want to clarify because we did touch on this a couple questions ago. They are asking if we know for sure that the salary max is $16,666.67. They had heard that it was $15,385. And again, the two differences there are going to be for calculation of an employer with employees versus a Schedule C independent contractor, sole proprietor with no employees, and their max being the 15,000 versus a higher number.
The only thing I'll add to that is I'm super glad John jumped in there. The way things have been worded as far as on the non-self-employment side, it's based on average monthly payroll costs or 2019 average. They've used a couple different terminologies through this, and it's forced the accounting profession to make some interpretations. The self-employed was the first, excuse me, I shouldn't say first, but it's one of the first that they gave us the actual ratio to do the calculation, the 100 or excuse me, 8 of 52. So their questions not off base. There seems to be several different numbers that are falling into the max wage calculation.
Okay. We are seeing the term mortgage interest in the wording on guidance for forgiveness. Wording at the time of application was interest on debt obligations. Can businesses include interest on all debt that was in place as of February 15th, 2020 versus mortgage only?
Our interpretation at this point is that they can. It includes, as this person stated, debt obligations. It was later that they added mortgage obligations but then said additional debt obligations in a separate section of the clarification.
Okay. Based on what was being said at the moment, it sounds like the ruling is if a company receives $50,000 on the PPP, the company will be taxed. Is this correct? And is this loan part of PPP also taxed under the current regulation?
So I didn't follow the numbers there as you were reading them, but in general, if an employer or a company received, I'll use 100 because in my mind it just makes it easier. If they received $100,000 of PPP proceeds, so the loan, the way we're reading it is if they had $50,000, if they used $50,000 of it for qualified costs and had $50,000 of qualified costs and the associated loan forgiven, thus having a $50,000 loan at the end of it, the 50 that was used for the costs would be essentially taxed by virtue of the expense being disallowed.
Okay. So the
whole
loan,
100, it would be the 50 that qualified for the debt forgiveness.
okay. So the loan is not taxable, but the forgiven expenses cannot be deducted. Is that what you're saying?
Correct. I mean, my interpretation of this was them backing into it so that the IRS didn't sound like they were the ones saying that it was taxable. They're just disallowing deductions.
Okay. Next question is, why are banks asking for a separate account? Gross payroll never comes out of a bank account, only net checks. And did you add any unemployment taxes to your payroll cost calculations?
Okay, great question, or several. The bank, some banks required a separate account. Some banks offered it. Some banks insisted. Every bank was a little bit different. At that point, as you saw in the one tab that I had down there, there's a pay period transfer tool. What we've told folks, no one wants to change their account that their payroll comes out of and has always come out of, because we all know that that's just a disaster trying to change something of that magnitude with a payroll company. So, but yet it states that you need to use the funds to cover these costs. So what we've done is said, look, if you have that separate account, pay your payroll costs out of your operating account as normal. But then what we did is we created that transfer tool so that you have the $100,000 limitation on some, so not all of them not all payroll is going to be eligible. This basically calculates what we're determining as the qualified number to then transfer from your COVID account over to your operating, and you're doing a good faith effort of using those funds almost exactly for what they were allowed to be used for. With that in mind, there's no way around having a true up or reconciliation at the end.
Okay. Um,
So anyhow, there might be some cases where it would match dollar for dollar. I shouldn't say that. So
okay. Next question. People are wondering when they will receive documentation for the SBA with regard to how to begin the forgiveness process. What documents would be taken into consideration? Can you talk on that at all?
yeah, so we're in direct contact with several banks and folks who are players in this arena, if you will, and have been part of trying to figure it all out the whole way through. I can tell you that they're still waiting guidance just like we are. And I tell everybody in every one of these seminars, please have patience when dealing with your banker. They're just as behind the eight ball with this as anybody else. I would say there's no way around needing strong payroll data. So if you have, adjustments or things like that in your payroll system as of right now, I would strongly encourage cleaning those up, trying to get your payroll data as orderly as humanly possible, because I strongly believe they're going to be pulling this from, the 941s and payroll reports. I would also strongly encourage putting a summary workbook or spreadsheet together to account for your expenses, rent, utilities, so on and so forth, and scan and attach the invoice itself. If you're actually using checks, you get the check. I would make the package as complete as humanly possible. Our concern, several of the attorneys that I work with throughout this as well, the concern is that once we hand these packages over, the package is going to, as of right now, the way we see it unfolding is the package is going to be handed to the bank. The bank makes their initial assessment of the situation, and then the bank hands that to the SBA. We don't believe, if many of you, as you went through the application process, you submitted your application, and then it could have been a week, 2 weeks later with little, no, or a lot of communication, the money shows up or the loan docs show up. We don't believe this is going to be too much different than that, in that you're going to submit your application and you may never have a chance to plead your case. The bank is judge, the SBA is jury, and back that comes with a number. So documentation probably will never have been as important as it is during this.
Okay, so we have one more question, Brad. Before I ask that one, if you feel like your question wasn't addressed, it's probably because we felt like there's missing pieces or it's very direct to your situation. I'm going to include my email as well as the info at Deleon and Stang that you see here. Feel free to follow up with those questions. Our last question here, Brad, is: the company has operating expenses that must be paid immediately in order to keep the doors open, but those expenses are not qualified PPP expenses. Are there repercussions for using a portion of the PPP funds to cover those expenses beyond the portion converted to the loan?
So again, this goes back to the other question that the other person answered. I can't tell you that you shouldn't do that in order to keep your doors open. I would say there's not guidance on that being allowed to be incurred. Like, if you use those dollars, keep the doors open right now, but that allowed X amount of dollars to come back in and the revenue in the next week, and everything worked itself out. I don't see I can't really say that I don't see a problem with that, but the intent of this was to be able to allow small businesses to exist and to live. Would take every chance or every opportunity you can to do with these proceeds what the intent of the program was, which was to employ people, bring people back to work, and keep your business alive. If you Obviously, if you are at a position where you're needing to keep your doors open, need-based issues, I would think, would be less relevant. Ultimately, just know that if you can't restore those with payroll costs, you're going to be sitting with a debt that needs to be paid back. And don't get lost in the fact that the payback period is relatively short, regardless of the interest rate. It's an 18-month payback period. So get some assistance on what that looks like after you're back open and you have a debt of 10 or 20 or $100,000 there. What does that payment each month look like? And evaluate, okay, what else should I not do now, or what else should I do now?
Okay. Well, Brad, we want to thank you, Dillian and Sting. We want to thank the Gaithersburg Germantown Chamber for putting all this together. Again, anyone that has questions, we are aware that some of this stuff is about as clear as mud. And as we continue to get guidance, we would recommend following our social media, looking on our website for updated guidance. We will answer questions. I put my email there. Our contact information is on the screen. And so if there's any way we can help, please reach out. And again, thank you to the Chamber and to our speaker today.
And I just wanted to thank Dillian and Stang and all of you for attending. We'll be sending out the video as well as the slides later today. Thanks, Brett.
Thank you, Laura. Thanks for the opportunity. We greatly appreciate it. It's been a great partnership.
Anytime, Brad.
All right, everyone, have a wonderful day and stay well.